Good morning and welcome to Financial Accounting. Today is day 14 of 30 for the fall 2022 semester. I finally have, I think, unless they move it on me, a good way of putting up on the screen what's going on today to remind you of due dates and see where we are going. So because we finished chapter 20, excuse me, because we finished chapter 6 on Tuesday, the chapter 6 problem is due today, and there are also 2 extra credit problems. We talked about this on Tuesday. The extra credit is because I wanted you to do all 3 methods, LIFO, FIFO, and average cost, but I didn't want to require you to do more than 1 problem. So one of them is the regular problem, and the other 2 are extra credit. So you can choose to do those or not. And if you choose not to do them, it will not negatively impact your grade. But of course, they are good practice for the exam that's coming up this weekend. We're going to be starting chapter 7 today. And so the chapter 7 pre-quiz should also be submitted today. As always, you need to score a 60% or higher to get full credit for that. Anything less than 60% is no credit. And then this coming Sunday, October 9th. So anytime between now and then, once you finish your chapter 6 work, you should be planning to take the exam sometime between now and Sunday. Just like with exam 1, 3 hours once you begin, but you can take it on any one of those days. And just make sure you open your book before you start the exam, because the software may prevent you from opening it once you've opened the exam. Second part of the project is due also on Sunday then. You'll notice if you look at the information on the Dropbox for chapter 4, you're going to use the specific companies that are called out in the directions for chapter 4. And the same is true for chapter 6. So chapter 5, you're going to use your company, the company you had approved to use for this semester. But you'll see in upcoming chapters on the next projects, there are definitely some chapters that the book tells you which company to use. And I guess by coincidence, it could be the company that one of you chose. Someone in here might have chosen Walmart. I don't know that off the top of my head, but everybody's going to use Zynga and Walmart for chapter 4. Everybody's going to use Best Buy for chapter 6. And you'll use your individual company for chapter 5. So for each project from here on out, you'll want to pay attention to what the directions say. And I have repeated those directions here on the Dropbox. Any questions about any of that? What's due, what's coming up, anything? Okay. Posted an announcement this morning that we did have a review session yesterday for exam 2. And although we did not have a lot of people attending, as I said, if there was even 1 person there, we would go ahead with the review session. And so in the announcement, I told you where to find the recording of that review session. If you are interested but were unable to attend, it's in the reference materials area in Brightspace. And you can see the link here right after chapter 6, because the exam covers chapters 4, 5, and 6. So as always, it's a YouTube video. It is pretty long because we did go through every one of the 14 exercises in the practice set. So as I've suggested before, I would encourage you to try the practice set on your own and then watch the video if you have questions. Contact me if you still have questions, but I did go through them in order from 1 through 14. So if you get stuck on say exercise 7, you know that you can fast forward through that video until you get to what you're looking for. Anybody with questions about that? So the exam covers chapters 4, 5, and 6. and give you one last opportunity while we're all here in class. If there's anyone who wants to talk about anything, review anything from any of those 3 chapters that are on the exam, be happy to do that. The new content for today is not on the exam, so it's much more important to me today that you're comfortable with those 3 chapters. All right. Well, if you do have questions, you know how to reach me. Send me an email, sign up. I do have some office hours still today, and I'd be happy to help. If it's a quick question, feel free to just shoot me an email and I can get right back to you. I'm always available. And since everybody's going to be super quiet today, which is not uncommon, we will move on to our next chapter. Oh, one last thing. Don't forget, no classes Monday, Tuesday. So obviously this class will not meet again after today until next Thursday. And on Thursday of next week, we'll be finishing up chapter 7. And chapter 7 is a bit of a shorter chapter than the chapters we've seen up to this point. So God bless you. Next Thursday, when we finish the chapter, I would expect we would have a significant amount of time potentially left in class. And so we may even start chapter 8 next Thursday. It won't change any of the due dates, but I'm just giving you a heads up. We'll see how much time we have left, but I would expect that we might have a significant amount of time. This chapter, I'm going to say traditionally, was not really a standalone chapter. Instead, cash was lumped in with receivables, which is our next chapter. So that's why it's a bit of a shorter chapter, but I believe that the reason that most accounting textbooks, and it's not just this Warren's textbook, being the principal author, but also many other textbooks now have this chapter broken out as a separate standalone chapter because they wanted to include internal control as a main piece of the chapter. So I don't want you to think that internal controls were not discussed before, the last 5 years or so. Absolutely, it was a part of every accounting textbook and has been for years, but it needed to take more of a front and center position. And we'll be talking today about why that is. Why have internal controls become such an important focus of accounting education? So as we look at the learning objectives for this chapter, looking at learning objectives 1, 2, and 3, they are all related to internal controls. And I'm going to maybe apologize in advance because there isn't a lot of what I think of as the doing of accounting for us related to internal controls. It's really thinking about the concepts, the topic of what does it mean to have effective internal control? Why do we care? Why again has it become, now part of a chapter title? Why has it moved to such prominence in accounting education? And then learning objectives 4 through 8 will actually be more of the doing of accounting, as I usually like to present it in class. So I rely on all of you to read the chapter outside of class, ideally before we start working on the chapter, but certainly as we're working on the chapter, and absolutely before you try to maybe take the exam that includes this chapter. So I'm not going to try to tell you everything that's written in the book. That's why I have you read it outside of class, but we will spend a little bit more time in this chapter like we did in the first chapter with talking about the topic and then get to the doing of kind of the second half of the second portion of the chapter dealing with the cash issues. Okay. I'll also mention at this point, when we get to the exercises that I put together for this chapter, I didn't do a great job of ordering them. And so the first exercise in the exercise set is not the first one we're going to do. That really should be at the end. So, but I wasn't able to, I tried this morning when I recognized that. I tried to move it to the bottom, but because other people had already opened it, it wouldn't let me make that edit. So we'll be doing the exercises a little bit out of order. Usually I try to keep them in the correct order, the order we're going to do them in class. So I don't know if you've heard that term before, Sarbanes-Oxley, also sometimes called Sarb-Ox or just SOX, S-O-X. But Sarbanes-Oxley refers to an act of Congress passed in 2002. Sarbanes and Oxley are the last names of the two gentlemen who were the principal sponsors of that legislation, one in the House of Representatives and one in the Senate, the U.S. This is a U.S. Law. And it was really a response to some very highly publicized, very public accounting scandals and maybe some malfeasance throughout the 1990s in particular. So you may have heard of some of them, maybe not, because you guys weren't alive and reading or watching business channels during the 90s, I would guess. But the company Enron is one of the big ones. WorldCom, HealthSouth, people in this area may be more familiar with what happened with Adelphia Communications in Coudersport, Pennsylvania, not too far from here. But what was happening in the 1990s is, business was going great guns. They were foolishly talking about the business cycle may have ended. There may no longer be the expansions and contractions of the normal business cycle. Most people knew that wasn't true, but they were looking at this long expansion and saying, hey, maybe it'll never stop. That's why it's called a cycle. It does go up and down over time. But there was a lot of changes that were happening in the accounting profession at that time as well. So there were a number of mergers and acquisitions happening among when I was in school in the late 80s, there were what was called the Big 8 accounting firms. And after all of this shook out, it was down to, I think at that point, it was the Big 4, maybe the Big 5 for a little while. So this is what was happening in the accounting profession. And I think this might sound familiar, at least as how it relates to what we're talking about in class. So day one in chapter 1, I told you, we talked about the purpose of accounting. Why do we do this stuff in the first place? Most of you probably do not aspire to be accountants, but every single one of you, if you are a business major, you are required to take this class. You're required to take managerial accounting. And why do we require that? Because every single one of you, no matter which direction you go with your career, you will encounter accounting information. You may be held responsible for a budget. You may have to be able to read financial statements to be able to manage a company. So that doesn't mean you're the one preparing those financial statements, but you need to be able to understand them and understand the power of that accounting information and how it can help you make a decision, either as an internal decision maker, management of that company, or as an external decision maker, potentially a stockholder, an investor, or an employee of that company. And so we know that these financial statements that public companies are required to prepare and have audited and share with the general public are the key source, the primary source of information about that company. And the vast majority of external decision makers do not have access to any internal information. The only information they have for decision making is the audited financial statements, that annual report that the company is required to share. So we, as external decision makers, potential employees, potential investors, potential creditors, we have to know that we can rely on the information that is in those financial statements. It has to be reliable. It has to be a faithful representation of what's actually going on inside that company, because that's the only information we have. So the process that I just described, the company prepares the financial statements, the auditors come in and give them their stamp of approval, and then they share them with the public. Well, what we're talking about in part here is that auditing piece, that auditor step. So what does that mean? Well, you have a firm of CPAs. So here in Jamestown, one of the big CPA firms is BWB, Buffamonte Whipple Butterfaro. And though the CPAs who work for that company are certified public accountants, in New York State now, at least, what that means is you have a bachelor's degree and a master's degree or equivalent in terms of the number of credits that you've earned. And then you're eligible to sit for the CPA exam, which is a national exam. Each state sets its own requirements for what background, education, and experience or combination of you need to have to even take that exam. And again, today you need the equivalent of a master's degree in accounting and to be able to even take the exam. Then you take the exam, you pass the exam, we hope, and then you are working for a period of time for an already licensed CPA. So you become CPA eligible, and then you get experience, and then you become an actual licensed CPA. After that point, you have continuing education, CTE credits that you need to earn every so many years to maintain your license, plus you're paying the fee every year to maintain that license. So we've worked, the accounting profession, we have worked to establish the credibility of our field by requiring a certain amount of education, requiring that you pass that exam that's a national exam, requiring that you have a certain amount of experience before you can hang out your own shingle, so to speak, so that you are a fully licensed CPA. And it doesn't stop there, because you have to continue to keep your credentials up to date to remain in practice. That what I just said, it has mostly been true for years and years. Now, the requirement of a master's degree is relatively new in New York State. Maybe 10 years ago or so, they brought in that requirement. Not all states, of course, have that same requirement. As I said, each state sets its own requirements for what you need to have in order to take that exam. Even 15, 20 years ago, that master's in New York State was optional. But if you had that master's, it removed 1 year of the experience requirement. So it was 2 years experience or a master's and 1 year experience, or equivalent of 150 credits and the 1 year of experience. So back to the 1990s, businesses are going gangbusters, the economy is booming, and we have all these CPA firms, the big 8, the national firms, so they have offices in the major cities all over the country, maybe even all over the world. And the CPAs at the time were doing this auditing, or what we call the attest function. I'll put that on the screen so that you know what that word is. So the attest function for CPAs or for an auditing firm is that they are auditing those financial statements, and then they attest to their reliability. But at the same time, those CPAs that were doing some of the attest function were also doing a great deal of consulting. And so they were acting as consultants for, in some cases, the same companies that they were supposed to be auditing. And the consulting fees that they were earning were vastly outstripping the fees from the audit, the attest function that they were performing. And so you can imagine what this looks like. I'm a CPA and my firm is engaged by ABC company to perform their audit. And it's a small amount of money, really a pittance. The audit, takes maybe a couple weeks out of the year. So it's a very small portion of what we do. And at the same time, I'm also consulting. That company is paying me separately different fees for providing business management advice to them, perhaps. And those fees are huge compared to the auditing fees. So, one, we don't want to jeopardize that consulting fee stream by telling the company, ABC company, hey, you're not doing your financial statements right. I'm not sure I can give you a clean bill, what we call a clean audit, or an audit opinion that has no findings. We don't want to tell ABC company, you got to change something in these financial statements because we don't agree with the way you address this or the way you presented this information. We don't want to tell them that because that might jeopardize this huge other revenue stream of the consulting fees. At the same time, I'm in kind of a cozy relationship with that firm because I'm working with the management on an ongoing basis in this consulting role. And so, it gets a little chummy. I'm a little friendly with them. And I don't want to rock the boat by telling them, no, these financial statements aren't accurate, aren't correct according to GAAP, generally accepted accounting principles. So there's another piece to this. The senior accountants recognize that they can make more money consulting than they can auditing. So traditionally, what would happen on an audit, you have a senior accountant, someone who's been through the mill, they've done this many times, they've been doing it for many years. And they have maybe some junior accounts, people who are CPA eligible, but don't yet have the experience they need, or they're still pretty green, they're still pretty new at this. And so the senior accountant was kind of mentoring them, bringing them along, training them in how to do an effective audit. But as the consulting fees continued to build, it was not as lucrative to be doing the audit. And so those senior accountants were becoming less and less involved. And so the people who were on the ground actually going out to do the audit were pretty new. And so the company, maybe it was a little easier for them to get away with something, intentionally or accidentally, that the auditors were less likely to catch errors in the financial statements because they're new at it, because they would tend to rely on the judgment of the company because those people have been doing it for a long time. And so all of these things led to, in part, the accounting scandals that were front and center in the national press in the 1990s, including, like I said, Enron, WorldCom, HealthSouth, Adelphia. Those are some of the big ones. And so Congress decided they needed to act to, one, is restore the integrity and the public respect for the accounting profession, because we, as members of the public trying to use those financial statements, need to know that we can rely on them. And accountants went from being a highly trusted profession to a very low ranked in terms of public trust, public confidence. And so that's where Sarbanes, that's the backstory of what happened with Sarbanes-Oxley. or why it came to require an act of Congress to maybe change things within the profession. So Sarbanes-Oxley, as I said, was passed in 2002. Some of the pieces that came out of Sarbanes-Oxley included that if you were performing the attest function for a company, you could, God bless you, you needed to maintain what's called an arm's length relationship. So you couldn't be consulting for the same company that you were performing their audit. Okay. We couldn't have that close relationship. And so what happened there is many of maybe all of the big accounting firms spun off their consulting services and they became separate companies so that could no longer happen, that you were doing the accounting and the consulting for the same company. Another thing that happened is up to the passage of Sarbanes-Oxley, we held the auditors responsible for the validity of those financial statements. And if something turned out to be incorrect, again, we blamed the auditors. Well, the auditors said it was good, so it's their fault if they didn't catch it. Now, in 20 years later, I think most people, it's pretty easy to see that really wasn't a fair burden to put on the auditors. The company has 52 weeks out of the year to be doing their financial statements, to be maybe doing something incorrectly, intentionally or not. And the auditors have maybe a few days to, if it's a huge, big audit, maybe a week for that audit engagement. It's kind of like a game of cat and mouse or hide and seek. The company's got 52 weeks to hide it, and the auditors have a couple hours or a few days to find it. That really wasn't a fair burden to put on the auditors. Now, since the passage of Sarbanes-Oxley, it is the chief officers of the company, so the CEO, the CFO, who are legally responsible for those financial statements. And if it turns out that those financial statements were prepared fraudulently with the intent to defraud and the investing public, that CEO or CFO, both, can be held criminally responsible. They can be fined, they can be sent to prison. And so it's a much different approach that we take now to who's ultimately responsible for the financial statements. Well, it's the company that prepares them. I think standing in 2022, it's easy to see that. It's easy to say, well, of course the company's responsible. They prepared them. But I'm telling you that 20 years ago, it definitely was not looked at that way. It was absolutely seen to be, up to the auditors to catch that if there was anything, fraudulent, nefarious happening with those financial statements. Another part, and this is what we're talking about in this chapter specifically, another part of Sarbanes-Oxley was a section of the bill called Section 404. Section 404 of Sarbanes-Oxley. So you can imagine how comprehensive this legislation was if it had more than 400 sections to it. But Section 404 of Sarbanes-Oxley deals specifically with internal control and compliance. I'm not suggesting that prior to 2002, companies did not have internal controls. That is not at all what I am saying. But starting with the passage of Sarbanes-Oxley, and then there was an implementation period. So sometime after the passage of this act, when Section 404 went into effect, companies had to be much more deliberate about outlining, about recording, about documenting the internal control processes that they follow in their company. And an additional burden on the auditors are now required to make a statement about the effectiveness of that company's internal controls. So when you look at the financial statements for the company that you chose for your project, they're always is a page that's the auditor's report. So there's always a section, it's the auditor's report. It tells you who the auditors are. That's going to be the name of a company, not the name of an individual. Do not confuse the auditors, which are the external CPAs, that arm's length relationship, with the internal audit committee. So companies now have a committee made up of people who work for the company, who are interested and have knowledge about the accounting systems within the company, who advise on accounting related issues. The external auditors must, in their statement, and it's usually a page, full page, or at least a few paragraphs in the annual report, and they say two things. They make a statement about whether the financial statements are prepared materially in accordance with US GAAP. So materially means in the big ways, all the ways that matter. We've used that word material or materiality a few times already. So they make a statement that yes, the company followed GAAP, or no, they didn't. So if the auditors are in for their audit and they find something that they disagree with the way a company handled an accounting issue, the first thing they're going to do is go to the company and say, we're not really sure that you did this correctly. Maybe it's something that's a brand new situation and the company had to make a decision. How do we record this? What do we do with it? And if the auditors disagree, they're going to go to the company and say, we disagree with your treatment of this particular accounting issue. And the company then has the choice. They can change it to what the auditors are suggesting, but they don't have to, because ultimately the company's responsible for their financial statements. However, if the auditors bring something like that to their attention and the company says, tough, we're doing it anyway, the auditors then are going to disclose that difference of opinion in their letter to that's within those accounting annual report. So it would say, prepared materially according to GAAP, except we disagreed with their treatment of this particular item. So it had to be a big thing. And so that's a part of the clean audit opinion, is having the auditor say, you're good, you followed the rules, you followed accounting principles in the United States. We're happy with that. The second thing that came out because of Sarbanes-Oxley is a statement about the company's internal controls. Are they effective? Do they have an effective system of internal controls in place? Prior to 2002, there was no statement about internal controls. It wasn't up to the auditors. It wasn't in their job description to talk about whether the company had effective internal controls or not. Now it must be there. If you were to Google Sarbanes-Oxley Section 404 compliance, I'm not going to do that for you right now, but if you were to do that on your own, what you would find is the major issue related to Section 404 compliance was the cost of compliance. So back in chapter 2, we didn't spend a lot of time talking about this in class, but I reminded you it was in the textbook and that you needed to read about it. In chapter 2, the book covers the characteristics of accounting, qualitative and quantitative characteristics, things that the information needs to be relevant, reliable, timely, faithful representation. One of the issues for accounting is a question of cost-benefit analysis. So when we think about the information that's in the accounting records for a company, we know that people are using that accounting information to make decisions about the company. And so in one respect, you might be thinking, well, the more information they can give us, the better off we are. The more ready we are to make a decision about this company, whatever the decision is we're trying to make. But we have to make sure that when we put more information in there, that it's actually going to be useful for decision makers. It's not helpful if we put in so much information. There's an old saying, and I know it's usually the case that people haven't heard these old sayings because you guys aren't old, but just bear with me. There's an old saying, you can't see the forest for the trees. Anyone ever heard that before? Can't see the forest for the trees. What do you think it means? It's the kind of thing your grandmother might have said. What do you think that means? You can't see the forest for the trees. Anyone have an idea? Aren't the trees the forest? But the idea is there's so much stuff there, you can't get the big picture. And that's really a concern with accounting information, is we put so much out there. Have you heard the term a data dump? So, when let's say companies or government agencies want to hide something, when do they release that information? About 5 p.m. on Friday afternoons, because it's too late to make the national, the 6 o'clock news. And they bury it on page 147 of the 450 pages that they throw out there. And they say, well, we told you it was on page 147. That's kind of what we're experiencing in accounting right now. As you guys were picking your companies, some of you asked about whether you should print their annual report. And anyone who asked that, I would have said, no, please do not do that, because the annual reports are in the 100+ pages these days. That was not true even 20 years ago. And there's a very financial reason that it wasn't true 20 years ago, because 20 years ago, yes, there was an internet, but not everyone was using it, and it didn't exist in the same way it does now. And because they're publicly traded, they're required to share those financial statements, their annual report, with anyone who asks, all of their stockholders, which can be hundreds of millions of shares of stock, and anyone else who asks. Because they're a public company, they have to share that. So what that meant by sharing that information was they had to print them. They had to mail them out to all their stock, actual bound copy to all their stockholders, and anyone else who asks had a legal right to those financial statements because they're a publicly traded company. Imagine the cost of having to print hundreds, maybe hundreds of thousands of annual reports, obviously every year because it's annual, mailing them out. And so at that time, annual reports were about 20 pages long, much smaller, because there was a logistics issue. Now that almost everybody accesses them on the company's website or on the SEC website, they have been free to expand, put more and more and more information in those accounting, in those annual reports. Some of it may be based on new requirements for new disclosures, like what I'm talking about here with the internal control piece. But some of it is just because they can, because it's not adding any real cost. It's a fixed cost to let someone, to have someone prepare that information. But that's a one-time thing. So as we're talking about internal controls, it's important to keep in mind that companies have always had internal controls, but they weren't as codified as they are now. And they weren't part of the audit process. And Section 404 compliance, bringing companies up to speed as far as what they needed to have documented, what they needed to have audited, added a considerable expense for each company. So the cost benefit analysis of, is it worth it to have this additional information? The cost of providing that additional information in this context for our internal controls, but it applies across the board with accounting. The cost of providing that information, who pays that? The company. The company has to pay the auditors. The companies have to pay their internal staff to prepare those financial statements. The company has to pay for the audit. Who benefits from having that additional information? The people who are using those financial statements, right? Those decision makers that we keep talking about, the people who are looking at those financial statements are the ones who benefit from having additional information. Again, I could argue there's just too much information. And so, and some of you may have already experienced that frustration when you're trying to work on your take it further real world annual report project. And it says, find this in the financial statements, and you've got 120 pages and you're trying to figure out where to even start. So some of you understand that about the too much information, but in general, more information they believe would be better for decision makers, but the decision makers don't have to pay for it. So that makes the question about how much information to put in, how much cost is worth it. That's what makes it a little bit trickier, because the people who benefit are not the ones who have to pay. Okay. I know that was a lot of information, including some historical background so that you understand where this came from and why we spend more time talking about it. But does anyone have any questions about any of that? Okay. So now that we know why companies have internal controls and why it is now a part of the audit process, and why for most accounting textbooks, internal controls have become kind of a focus of one of the chapters. And again, that wasn't the case even 10 years ago. Now we can talk about what internal controls are. Now we know why they're important and why we have to address them. I would encourage you to Google Sarbanes-Oxley Section 404 cost of compliance and see the staggering numbers of how much it costs the economy and how much it costs each individual company on average to comply with 404. So we can see on the screen, before I move on to the next screen, that internal controls are the way that we protect the company. We protect the assets of the company. We protect the company by ensuring that we are complying with all of the relevant rules, laws, and regulations, and that the information that we are putting out to the public is accurate, that it is all those things we talked about, the characteristics of accounting: faithful representation, reliable, timely, and so on. So number one here, safeguard its assets. Well, there are two assets of a company that are the most vulnerable assets, meaning somebody could abscond, somebody could steal them if they are vulnerable. And so the company has a responsibility to protect, number one, the cash of the company. So cash is the most vulnerable asset because, theft, fraud, more readily stealable than any other assets of the company. The second most vulnerable asset of a company that sells a product is the product itself, their inventory. And so we just spent the whole chapter talking about inventory, chapter 6, and we spent a few minutes in class last week talking about inventory shrinkage and what that means. So part of the internal controls are to help prevent or limit that inventory shrinkage, especially the part that might be the result of theft by employees or by people outside the company. So our two most vulnerable assets, cash, which is the other part of this chapter, and inventory, that was the focus of our last chapter. So I don't want you to think, looking at this diagram, that theft and fraud were just rampant in every company prior to 2002, and that Sarbanes-Oxley passed and now it doesn't exist anymore. It is not at all true that most companies had weak internal controls. But what I would suggest is that it was much easier and much less apparent when companies had weak internal controls prior to Section 404. This diagram, I think, makes it look like every company had weak internal controls. Every company was vulnerable to theft and fraud. And I don't think that was, I know that wasn't the case. But I would say it is much more minimized now. And I don't know if there are data out there to suggest that the cost of implementing Section 404 has been recouped, that we've gotten our money's worth. Because again, if you Google that, you'll see the vast number of zeros on the cost of compliance number, and that's ongoing. It was extreme at the implementation point, and it is ongoing today. There is a dramatic cost for companies every single year to comply with the requirements of Section 404. So I already mentioned that all companies, all publicly traded companies, their auditors are now required to make a statement about the effectiveness of the internal controls of the company. This is just an example. I'm not going to read it to you. If you want to read it, I'll give you a second to read it. But I've already explained to you that it is a requirement that the auditors address whether the company has effective internal controls, whether they are protecting the assets of the company, whether they are protecting making sure that the company is not vulnerable to fraud or theft, and that they are complying with all of the relevant rules and regulations. I've already really talked about this. Internal controls. First, we need to have a framework of and it really does start from the top down. The essential piece is that management takes it seriously, that management itself follows the internal control framework, that they are not taking liberties and expecting their employees to hold to one standard if they're not setting the tone for the internal control environment for the company. Okay. So I mentioned control environment. We need to make sure, and there's a typo in here, and if you see it, I apologize. I did not make these slides and I'm not able to edit them, but there is a typo. So it is up to the company to be scanning the environment on a regular basis to look for potential risk, especially when the company undergoes a change, if they change the way they are doing business. So COVID, of course, changed the way many companies do business, and that required a reevaluation or reassessment of the risk of exposure that company was taking on by changing their policies and procedures. So you need to have effective procedures in place to make sure that the company is, again, the assets are protected and that we're following all of the relevant rules and regulations. And we need to constantly, God bless you, be looking for risk and making sure that the procedures are being followed. Examples on this slide of some of the control procedures. I think though that's large enough. They are also on the next slide, but I think those are big enough to read from here. So we need to make sure that our personnel know how to do their job and what's expected of them. So that includes things like having a employee handbook that spells out for the employees what's acceptable, what's not, what are the consequences if they don't follow the rules or the requirements of their job. It is a good internal control process to make sure that people are cross-trained and that you don't only have one person knowing how to do a job or only have one person doing that job ever, because if no one else is ever seeing what you do, it's much easier to violate those internal control requirements. Mandatory vacations. So many companies will require that on an annual basis, each employee, or certainly each employee who's in a position where they could be vulnerable, is taking many companies have a rule that you have to take a solid week, 5, if you work Monday through Friday, 5 work days off. You take a solid week off, because again, that when no one else, when you're not there, someone else is usually going to be covering for you, or at a minimum be aware of what your duties are during that time. And it makes it much more difficult to violate the internal control processes. The more people, and you know this, the more people who are in on a secret, the harder it is to keep it a secret. So having other eyes, having 2 sets of hands, if you are handling cash, for example, having 2 sets of hands on that cash is an important control procedure. Separating responsibilities for related operations. So the person who writes the check should not be the person who's doing the deposit. So you should have someone writing the checks. You should have a different person doing the bank reconciliation. We'll be looking at those on next Thursday, bank reconciliations. Proofs and security measures. So doing spot checks on your inventory, making sure that you have multiple eyes on a document. So if you have a shipment that's coming in of product from your customers, somebody needs to be actually confirming that what was on the invoice is what was received. So you've got someone counting it when it arrives and making sure it's the right product. You have someone else checking the price on that product to make sure that we were charged the correct amount by our suppliers. I'm not going to go through each. I've really kind of already gone through each one of these, so I'm not going to talk about each one of those slides individually. Please make sure, as always, that you read in the textbook. And if you have questions about it, if something didn't make sense to you, obviously you should ask at the beginning of class, ask right now if you have a question. I think this is an important slide, warning signs of internal control problems. So what should you be watching for? So warning signs with regard to people, abrupt change in lifestyle. So they seem to be spending beyond their means, beyond what their job would allow them to spend. There's a reason that many companies now do credit checks on potential employees, because that's a red flag if someone has bad credit, that they might be a risk as an employee. Whether you think that's fair or not, that is a reality in many, especially upper level jobs. Maintaining close relationships with suppliers. So I was just talking about making sure that what you receive from the supplier is correct. It's the right amount. We're being charged what we agreed to pay. We're looking there, of course, for kickbacks or money that's being paid as a bribe. You give us our business and we'll give you 5% of every invoice. Refusing to take a vacation. So you don't want someone else to have a chance to look at what you're doing. And I just talked about why many companies will require that you take a solid week off once a year. Borrowing from other employees, substance abuse issues, all of those are warning signs because they can lead to trouble, lead to a violation of those internal control policies. Warning signs from the accounting system, missing documents, gaps in transaction numbers. So every transaction, every check we write, for example, is numbered sequentially. If one is missing and we can't account for it. So if you made a mistake on a check, you would never just tear up that check and throw it out. You would void it and keep it in the file so that there is a record that that check was not actually used. Unusual increase in customer refunds. That's kind of an odd one. In a grocery store, for example, I have heard stories of people who are working in a grocery store, accepting payment from the customer, and then adding coupons onto their bill, well, subtracting them, I guess, from their bill, and then pocketing that cash for the coupons. So the customer paid full price. The employee puts a coupon in the drawer and takes, the $1 for the coupon or whatever. Differences between daily cash receipts and bank deposits. So what's happening there? Sudden increase in slow payments. So customers that were keeping their bills up to date, all of a sudden our records show they haven't paid, but they have been paying on time. We particularly problematic if we are dealing with cash. As I said, cash is the most vulnerable asset. So it is not, I don't know if you've ever been trying to think like Kentucky Fried Chicken, at least used to have a little, I don't know, not monitor, a little display at the drive-through that showed how much you owed. And there was a note on there that said, if you're asked to pay something other than this amount, please contact the manager. Because, they were concerned about an employee saying you owe $20 when the bill's only $18. Again, the $2 goes in the pocket. So you want to be very watchful when you're dealing with cash. It's a big temptation. Backlog in recording transactions. Maybe you are trying to, thank you. Maybe you are trying to keep something hidden, something that shouldn't have been happening. So I think those warning signs are very telling and something that you should be keeping in mind if you are in a management type position in a company. Of course, it's important to communicate information so that your employees know what's okay, what's not, what's acceptable, the importance of having written policies and procedures, and that management communicate those policies and procedures. An organization in Cattaraugus County and that I volunteer for just updated their employee manual, and every employee of the organization had to be given a paper copy of that manual, and they were given like 3 days or whatever to read through it. And then they had to sign a statement that said that they had received that manual. So management sending a message about this is our process, these are our requirements, we're taking it seriously, and you know what's going to happen if you violate them. There should be, in an employee manual like that, a written disciplinary policy. So what happens if you break the rules? Should be an escalating policy. Maybe the first time you get a verbal warning from your supervisor, the next time it's a written warning, maybe the third time it's, suspension, you lose a shift or 3 days without pay or whatever. And maybe the fourth time your employment is terminated. So that you as an employee have a right to know what's expected of you. It's not fair to discipline an employee for breaking the rules if they weren't notified that these are the rules that you must follow. Again, it comes back to management setting the tone for what's acceptable, regardless of what they put in writing. They need to send the message that we really mean it. If we said you must do this, you have to do it. I know it says it in the manual, but are we following through? And are there consequences for breaking those rules? So limitations of internal controls. If there's always a human element involved, management has to be setting the tone. We have to recognize, and you see the bottom bullet point there, something I just talked about, cost benefit considerations. We don't want to put such extreme limitations on our employees doing their job that they are no longer effective in their job, that it costs us more than it's worth. Let's take a look then at our first exercise, which is actually, remember, exercise 2. And maybe some of you have already looked at this as I've been talking, but please read through this. We talked about what section 404 is, and obviously this is a multiple choice question. I'm just going to ask you to read through them, choose your answer, and then anyone who finds the correct answer, feel free to volunteer that. Which one of these do you think is true? Or letter E, none of these choices. Which one? I'm sorry. D, letter D. So section 404 requires management's internal control report to state the responsibility of management for establishing and maintaining an adequate internal control structure and procedures for financial reporting. And they must contain an assessment as of the end of the issuer's fiscal year of the effectiveness of the internal control structure and procedures of the issuer for financial reporting. Exactly. Thank you. Going then. Faith Casson has recently been hired as the manager of Gibraltar Coffee Shop. Gibraltar Coffee Shop is a national chain of franchised coffee shops. During her first month as store manager, Faith encountered the following internal control situations. A, Faith caught an employee putting a case of 1,000 single-serving tea bags in his car. Not wanting to create a scene, Faith smiled and said, I don't think you're putting those tea bags on the right shelf. Don't you think they belong inside the coffee shop? And the employee returned the tea bags to the stockroom. I'm going to, as we work through this, I'm going to say there are some internal control procedures that are maybe a little more subjective. So where this question, you have to answer whether you agree or disagree. That implies that it's okay to disagree, but that doesn't mean she was wrong. Some actions are absolutely clearly right or wrong, and some have gray areas. So I'm saying this because I don't necessarily agree with what the actual, the textbook answers are to this question. So I find it actually weird that you're marking it right or wrong when it says agree or disagree. If I say I agree, how can I be wrong? It doesn't say, is this the correct way of handling the situation? Agree or disagree is more opinion based. So I don't think there should be, I don't think they should have phrased it that way. That being said, without looking at what the textbook or what the, the green check answer is, what do you think of the way Faith approached this? What do you think? Regardless of what they mark as the correct answer. Did she address the situation? Did she set management tone that it's not acceptable to take home product that belongs to the store without paying for it? Would you have handled it the same way? And if not, what would you have done in her same situation? Yeah, Kenny. Yeah, go ahead. You would have yelled at the whoever, the employee. Okay, so you would have made a very clear point. What are you doing? Those aren't yours. Mhm. Okay. And so it seems like maybe she didn't send a strong enough message that maybe it was kind of a cat and mouse. It's, I caught you, making a joke about it. Yeah, so maybe she could have sent a stronger message. I think the reason, and maybe part of the reason I think it's okay, and I'm not saying I would have done the same thing, but part of the reason I think maybe it's okay is because she is brand new. She just came to this store. It's her first month. And she's trying not to make a scene, maybe in front of customers or something like that. I don't know. It was in the parking lot, so there certainly could have been customers around. So she did, in my opinion, she addressed it. She did send a message that that's not okay, but someone else might have handled it a little bit more strongly, and that's probably preferable. They're also, I'm just going to say it, there's probably a difference between the way some employees would handle it, differently than other employees, and it may have something to do with who the employee is. That Faith is a female and the employee was a male, and she's trying not to be the heavy. I don't know. The answer, for those of you who've already hit the check my work button, probably you already know this. The answer says, I disagree because she's not followed the internal control principle of safeguarding assets. She did safeguard the assets. She got them from the employee, and they were returned to the store where they belonged. Could she have been a little bit more forceful about it? Probably. Letter B, Gibraltar Coffee Shop has one cash register. Prior to Faith's joining the coffee shop, each employee working on a shift would take a customer order, accept payment, and then prepare the order. Faith made one employee on each shift responsible for taking orders and accepting the customer's payment. Other employees prepared the order. So what she has done here is implement a process of separating duties to make sure that, and just picture this, before, when one employee did the entire process for one customer, there's nothing to prevent, that employee's friends from coming in and saying, hey, give me, the super extra double deluxe, but only charge me for the basic, whatever it is, coffee that they're selling. And because no one else was involved in that transaction, they see that the employee taking an order, accepting payment. There'd be no reason to think that they didn't make the proper, in this case, coffee drink. So having that separation of duty where one person accepts the payment and then the other person prepares the order does limit the possibility of that happening. Could the two employees be in cahoots and work on it together? Maybe maybe both of them are friends with the guy who comes in. I don't know. But I think she's done a good job here of handling the situation because she followed the internal control principle of assignment of responsibility and followed the internal control principle of segregation of duties or separation of duties. Okay, so she is making some progress. Also, from a public health standpoint, the person who is accepting payment should not have then been touching the food. Okay? You don't touch cash and then touch food unless you are washing your hands in between. Doesn't say anything about that, and obviously that would not be very efficient. Because only one employee uses the cash register, that employee is responsible for counting the cash at the end of the shift and verifying that the cash in the drawer matches the amount of cash sales recorded by the cash register. Faith expects each cashier to balance the drawer to the penny every time, no exceptions. Does anyone in here ever work in a position where you were running a cash register and accepting cash payments from customers? Sam has. Anyone else? Okay. Without telling who your employer was, if you're comfortable, what was your employer's policy regarding that? How did you handle it? You counted your own drawer? At the beginning of the shift? Okay. At the beginning of the shift, they handed you a drawer with X amount of money in it? Did you count that? And that's typical. I'm just going to tell you, you put yourself at risk by not counting it, because they told you, just throwing numbers out there. They told you, here's your drawer with $100 in change, and you took their word for it. Not suggesting they would have intentionally shorted you, but it could happen. So at the end of your shift, when your drawer has the wrong amount in it, how do you know you started with the right amount? You don't. Yeah. So that's the story that I get from virtually everyone who tells me that they worked with a cash register. I've never had someone tell me, yeah, I counted my own drawer before the shift. But hopefully you can see why you were putting yourself at risk without even realizing. Okay, so you counted it, but then someone else double counted it.
Yeah.
Did you run a report so you knew how much was supposed to be in there? Okay. So in this case, where Faith says you have to come out to the penny, and that employee is running the report so that they know how much exactly is supposed to be in there, and they know it has to come out to the penny, they're 4 cents short. What are they going to do? Your drawer is 4 cents short, and your manager says it must come out to the penny or else. What are you going to do? I'm going to take 4 cents out of my pocket and throw it in the drawer so it matches, right? Sam, did your drawer normally match to the penny? Did they have a policy? Okay. Did they have a policy about how much short or over was acceptable? Yeah. So most stores will have that kind of a policy that if it's within $2 or $3 or whatever. I think those numbers may have come down a little bit because most transactions aren't with cash anymore. And so you're dealing with a lot smaller numbers, but most stores do have a policy. If you're within X dollars, it's okay. Because you know what happens at the end of your shift and someone's order is $19.01. You don't have a penny. They don't have a penny. You don't want to open a new roll of pennies and have to count 49 pennies. You're just going to say, don't worry about it. Just like sometimes people say, keep the penny. I don't want it. And maybe you leave it in your drawer. Maybe you have one of those little things next to your register that's, leave a penny, take a penny kind of thing. It's really not a good idea to say that it must come out to the penny every time, because that's not realistic, that it's going to come out to the penny every time. You might miscount. You might, a penny falls into the register. Sometimes customers put their money on the like conveyor belt, and even though they're not supposed to. So for this exercise, has Faith done a good job? No, she has not. There's another issue here. And I don't know if anyone else wants to share your experience with a cash register, but the other issue here is that the employee knew in advance how much was supposed to be in the drawer. And that's not a good control procedure either. I'm not saying it doesn't happen in most circumstances, but it's not a good control procedure. It is absolutely a good control procedure, as Sam just described, that two people counted the money. Having two sets of hands or two sets of eyes on that money is a very good control procedure. But the employee who's responsible for that drawer should not know how much is supposed to be in there. Because that, just like I said here, that gives that employee a chance to correct any differences. The company should also have a policy of what happens if you're not within that, let's say, $2 of the report of sales. So what should happen? Some kind of an escalating process, oral, written warnings, suspension, termination is a typical escalating disciplinary process. Anyone else want to share us information about, without saying a company, share an experience that you had working with a cash drawer, how it might have been different than what we've already described? All right. And let's keep going then. No one else has anything to talk about. Exercise 4. Financial statement fraud. A former chairman, CFO, and controller of Don Kenny Incorporated, an apparel company that makes sportswear for Pierre Cardin and Victoria Jones, pleaded guilty to financial statement fraud. So remember, prior to 2002, the managers weren't held responsible for the financial statements. Now they are. The top management, CEO, CFO, are now responsible, criminally responsible for the accuracy, the validity of those financial statements. This is a different situation anyway. I don't know when this happened. It could have been prior to 2002, because in this case, it says the managers used false journal entries to record fictitious sales. Why would they do that? Why would anyone record sales that didn't happen? What incentive would there be for these managers, 3 of them, for recording fictitious sales for their publicly traded company? Why would a manager, why would anyone record fictitious sales that didn't actually happen, but they pretended they happened, to inflate the income on their income statement? Why would they do that? What's in it for them? And what would they get out of that, do you think? How would that benefit them? Okay, so maybe they're trying to attract more investors. Could be. Anything else? Can you think of any way that it would personally enrich them to make the company look better than it actually is? And we'll get to the other things they did in a moment. Okay, so maybe they're stockholders, right? So it's not at all uncommon, it's very common, that if you are a upper management for a publicly traded company, that you also own stock in that company. Either stock that you've purchased on your own or stock that has been given to you as part of your compensation package. And so if a company looks better than they are, then the value of your stock is going to go up, right? You make more money. Dividends could be a part of it, but we still have to have the cash to pay the dividends. So recording sales that didn't happen isn't actually going to increase our cash, but it would make the board of directors believe even that we were in a better financial situation than we are, and could therefore maybe afford to pay those dividends. Sure. So there's probably something in it. Probably these upper managers are stockholders. They're owners of the company, part owners of the company. It also could be that they get bonuses paid by the company based on performance. That's extremely common, that there would be goals set if you reach, just like if you're a sports fan, just like there are bonuses for athletes if they get, MVP or something like that. If they're the Super Bowl MVP, they probably have it written into their contract. You think Tom Brady has it written into his contract if he wins the Super Bowl and gets MVP, that he gets a bonus for that? It's kind of hard to fake you won the Super Bowl or that you won MVP. That's a pretty concrete thing. But for these financial officers of the company, their bonus structure probably includes some incentive for reaching a certain level of sales, a certain profit margin, a certain whatever. All of these financial analysis tools that we're talking about this semester, they probably have goals or benchmarks set. If you do this, then you will get that. And if you don't reach that benchmark in sales, bonuses are less, or maybe you don't get a bonus. So very realistic to think that the company, these managers could be creating these false journal entries because they want to personally enrich themselves by getting higher bonuses, by having the stock price increase on the stock that they own. What else did they do? They hid inventory in public warehouses so it could be recorded as sold. Remember, they reported that they had higher sales, so they also should be reporting cost of goods sold. There's a couple famous business cases. I'm not going to go into all of them, but just so you can see how this might work. So they have to report the cost of goods sold. But remember, we said if you, the way we do inventory is at the end of the period, we do a physical inventory, we count it, we assign a value to it, and anything we don't have anymore, we consider to be sold. Well, if they're reporting sales, but the cost of goods sold isn't going up by, keeping that gross margin at a relatively constant percentage, somebody's going to ask questions. That's definitely a red flag if the gross margin percentage or ratio is way out of whack this year. And so they need to get that inventory off their records as well. And so they pretend it was sold. It still exists. The company still owns it, but it didn't get counted in that physical inventory because they literally moved it off the premises. There's a pretty famous case where they didn't actually move it off the premises. They loaded in trucks, like the trailer part of a semi. They loaded it in those trailers, and it was physically sitting on the premises, but they didn't disclose that it was there. And so the auditors, when they were auditing the inventory, didn't catch it. They did eventually get caught. There's another thing that happens, or can happen, has happened, that they at the end of the year, they record a bunch of sales and they actually ship the product to the customers, but they tell the customers, if you don't want it, just return it. So remember, in our 4-step test of how do we know if it's okay to record the revenues, we said one of the steps is there has to be an agreement between the buyer and the seller. Well, that's not what I just described. The company said, we're just going to ship it to you. And it's December 27th. So we're going to ship it to you. And if you don't want it, just return it. Well, when's that return going to come in? It's going to come in after the first of the year, right? So they record the revenues in that year, and then they record the return the next year. They're just kicking the can down the road a little bit. And then we'll worry about that next year. And so it just escalates from there. They've artificially inflated their sales. That process that I just described has a special name because in some circumstances, it has happened more than it ought. It's called channel stuffing. So you ship the product, you stuff that supply chain downstream, and then you deal with the consequences later if you do have those returns. This case, the other thing they said happened is they required sales orders to be backdated so that the sale could be moved back to an earlier period. So what would that look like? they had a sale on January 2nd and they said, just put December 29th on it. It's okay, it's okay. And that would get the sales into the prior year when they actually hadn't happened on that date. And we spent a good amount of time in chapter 3 talking about recognition, chapter 2 as well. What date do we put on that? When do we recognize that sale? All 4 of those steps have to take place. If the goods weren't shipped until January 2nd, we can't record the sale. It's not proper to record the sale in December, but it could serve the personal financial interests of that CEO, CFO, and the controller of that company. So why might control procedures listed in this chapter be insufficient in stopping this type of fraud? I like answer number 4. There was no conspiracy to commit fraud. Well, the 3 of them were working together. That's kind of the definition of conspiracy. And the answer here is that senior management was involved. And so it becomes much harder to detect it. Who's going to question the CFO when this, or the controller, which is the head of the accounting department? Who's going to question the controller? It's your boss, and your boss comes to you. You're just an accounting clerk. Your job is to enter the sales transactions. And the controller, your boss, or maybe your boss's boss, comes over to you and says, yeah, that entry, it's not supposed to be January 2nd. It's supposed to be December 29th. There was a mistake there. Just change that to December 29th, would you? Are you going to stand up to that? Are you going to stand up to that? Are you going to tell the controller, no, I'm leaving it on January 2nd? What do you think? It's kind of hard, isn't it? Put yourself in the place of, this individual, accounting clerk, maybe jobs are hard to come by. I've got a nice job, good benefits. I've got a family at home. They depend on my income. And if I tell the controller, my boss, or my boss's boss, if I tell that person, I'm not doing that, how long are you likely to have your job? Probably not very long, right? We have whistleblower protection, but in the meantime, you've lost your job and your income stops while you work that out. It's really hard as an employee to do the right thing when your boss is telling you that you need to do something else. It's very hard to stand up for what's the right thing to do. And benefit of the doubt, maybe the clerk doesn't even know it's not the right thing to do. Because you're new at your job and the controller tells you to do it. You're like, oh, okay. Must be that's how you do it. Would an audit committee made up of representatives from senior management be effective in stopping this type of fraud? Well, who are those representatives from senior management going to be? The CFO, the controller, they're in on it. So unfortunately, it is not possible to stop all fraud. And that's why, going back to what I said a little while ago, that's why it made sense with Sarbanes-Oxley. And in retrospect, it should have been that way a long time before. It made sense to shift the burden of responsibility from the auditors, who have a very limited time to try to find errors, to the management of the company for the accuracy, the validity of those financial statements. Because the managers know or should know what's going on. They are the ones responsible. And so it absolutely makes sense to say, we rely on the auditors to do due diligence to try to unearth this kind of fraud. And sometimes it does get caught, and that's how we know about this particular case. But it's not fair at all to expect the auditors to find it when you're dealing with collusion at the highest levels of the company. The problem is, as you engage in this kind of behavior, as you're kicking the can down the road, it just keeps escalating. It just keeps growing and growing, because last year we needed to reach sales of this amount, and next year we have to get even more sales, but oh, whoops, we reported all those returns in January. And that inventory that's now sitting in that public warehouse, I think it said, right? How do we get that back in here without anyone knowing, so that we can actually sell it? So it becomes, the bigger it gets, the longer it goes on, the harder it is to hide, regardless of who's perpetrating the fraud. Questions, anybody? We have just a little bit of time left. Then I want to talk, I'll just do this one more exercise. So as Sam was talking about working in an establishment where he was in control of a cash register, and that there would be a count of his drawer, and he would count it and management would count it, and there was a report that said how much should be in there. That report of how much should be in there is the amount that would actually be reported as sales. But the cash we report has to be the amount that was actually in the drawer, minus any starter cash. And the example I said was started with $100. So subtract out that $100. The cash that you report as received has to match the exact amount of cash that was actually left in the drawer. And there could be a difference. And if you think about a place like Walmart or Wegmans that has, you know, feels like dozens of cash registers, and in their busy season, they've got many of those cash registers running. Imagine how that magnifies times even 10 cash registers, times 3 shifts a day, times 365 days a year. If every time it's $1 off. So Sam said, you know, within a couple dollars would be okay. But imagine every single time, every shift. So that's 30 registers, 10 registers, 3 shifts a day. That's 30 registers a day, each off by $1. If they're off in the same direction, that's $30 times 365 days. That becomes a significant amount of difference, right? It matters. So businesses that do cash business will employ an account called cash short and over to absorb those differences. And then at the end of the period, they're going to record that, depending on whether it's over or under, they're going to make an adjustment for that difference, the net difference. So some are going to be over, sometimes it's going to be under. If you are a business, are you more worried about your employees' cash drawer being over or being under? Which one? Under? Why do you say that? Okay. If it's over, where did that money likely come from? Probably not. I'm really big on tipping, but it's never occurred to me to tip the cash register or the clerk in the grocery store. It could be, but if you're working like in a place that gets tips, the tips don't go in the drawer, right? They go in the special jar or whatever. What did you say, Chesney?
Like they're allowed to keep the tips, yeah.
I may be missing out on an opportunity to tip someone. I have to keep that in mind. But the tips don't go in the register probably, right? Yeah. So that's very interesting, tipping a grocery store clerk. So does anyone else, we heard, maybe we're more concerned about being under because that means we're losing money, losing cash. Does anyone disagree with that? Does anyone think they'd be more concerned about it being over? I kind of think I'd be more concerned about it being over, because that probably means that might mean they didn't give proper change to their customers. And so you don't want to upset the customer because every time I go in that store, they don't make the change right. Right? So I'm going to suggest it's probably a little bit of both. Sometimes it's over, sometimes it's under. Because of those situations we've described, just keep the penny, I don't want it, you know, that kind of thing. As we only have a couple minutes left, let's finish up this exercise and then we'll be in good position for next Thursday. So what does it tell us here? The actual cash received from cash sales was, so we have to report this as cash. We actually received $78,956. We can't record cash that's anything different than what we actually received. It has to match. But the amount indicated by the cash register totals, the manager ran that report, or the cashier ran a report at the end of her shift, and it said that the sales were $78,995. Sales. Okay. So we need to report the revenue that matches the actual documented sales that we had. But that's not how much cash, and we actually had less cash than that. So what's the difference here? Thank you. $39. Do we need a debit or a credit to make these match? A debit. And that debit is going to go to that cash shortened over account. Sometimes the cash might be higher than the revenue, and so we'd need a credit to make them match, right? So those debits and credits are going to net together, you know, some high, some low, negatives and positives. And at the end of the month or at the end of the period, we're going to look at what's left in that cash shortened over account. And probably what we would do with that is it would probably be a net debit balance, and we would simply record that as an expense because we need to zero out that cash shortened over account at the end of the period. You can't just leave it there to ride. Okay, so we would zero it out by crediting cash shortened over. If this was the lump sum entry at the end and we are only $39 off, we would credit cash shortened over $39 just like we would close an account, as we talked about in chapter 4. And then the debit would be to probably miscellaneous expense, something like that. You can't let it ride. It has to be zeroed out. It has to be closed. And we would usually close it to some kind of a miscellaneous expense or something like that. And we're only worried about it, as we've been talking about through this class, as far as internal controls, we're really only worried about that number if it's material. And every company is going to decide what's a material amount. As Sam suggested, maybe it's just a couple dollars per employee per shift, and we're not worried about it if it's less than that for each employee. If it becomes a material amount in total, then we're probably going to have to think about how do we fix this? How do we address it? Maybe it's additional training for our cashiers to make sure that they're, I don't know, giving change correctly or whatever. So that's the end of class for today. Thank you for being here and for bearing with all of the talk that goes with the internal control piece. Good luck on the exam this weekend. See you next Thursday. Enjoy your long weekend.